Hello and welcome to a very special video. Today we are discussing the pros and cons of investing in real estate through real estate investment trusts versus rental properties with my fellow investor Anna from the Panda Boss channel. She is a fellow investor with an amazing YouTube channel called Panda Boss, Personal Finance and Bossing Life. I have her channel linked in the description below and at the top of the screen. Say hello, Anna.
Hi everyone, my name is Anna. Thank you so much, Ben, for this opportunity to collaborate with you. I've loved your videos ever since I came across them. I've worked in finance for the last 7.5 years and I've realised that I want to become financially independent. So I spent the last year getting myself out of all the consumer debt that I've had, and now I'm focusing purely on investing.
Before we get into this video, please take a moment to subscribe to her channel and to mine as well if you've not already. Give the video a like to help get it out to more people who are interested. Take it away, Anna.
So first things first, we should explain what a REIT and rental property are. A rental property is essentially when you invest in a specific property like a house or a flat and then rent it out for income, i.e. when your tenants pay you rent. Although there are some people who buy properties with cash, the majority of people do take out a form of a loan called a mortgage to pay for this. A REIT stands for Real Estate Investment Trust. It's essentially a corporation which owns many real estate assets that produce income. Think of it like an ETF, just with property. These assets can be anything from office buildings to hospitals to hotels and residential properties. It is worth noting that these funds are mandated to pay out 90% of their profits as dividends, which means they tend to be a pretty reliable source of dividends.
REITs take very little time to invest in beyond the research necessary to decide which REIT or REITs you want to buy or sell. Making a purchase on a computer or phone takes only a couple seconds and you're done. When buying a rental property, research is also necessary to ensure you buy the right property. However, the time and effort you invest is just beginning. You cannot purchase the property with the click of a button. You'll need credit checks, you will likely need to find a real estate agent, get pre-approved by a lender, make an offer, have a home inspection, get insurance, establish utilities, and close and sign a lot of paperwork. The process typically takes at least weeks but often months, especially when searching for the right property to buy. You may need to make the necessary repairs immediately and will likely need to continue to do so throughout the time you own the property. You then need to find renters, maintain the property, ensure you receive rent payments, be responsive to renters, and find new renters when old renters move. Finding new renters can take months depending on your location and other factors. Selling the property will again require many steps and often takes months to find a new buyer.
So REITs are far more liquid than a rental property because they are publicly traded on the stock exchange. It is generally accepted that REIT trading is very high volume, so they are seen as very liquid investments. With a rental property, the process of selling can be extremely daunting. Yes, you can get lucky and sell in a couple of months, but as far as I'm concerned, with the people that I know who are selling, it's taking longer and longer for everyone to sell their properties, which actually means that it's also taking longer for people to buy properties. Take into account the fact that in the UK, you have to go through so much paperwork, you have to enlist lawyers, you have to carry out property valuations and surveys, you have to arrange house viewings, you have to do so much stuff. And more often than not, you also end up in a chain where you are waiting for someone to sell their house before they can move into your house, and the whole process just takes even longer. It took my parents a whole 8 months between listing their house for sale and handing over the keys and getting the money for their sale. My understanding is that this process is a little bit quicker in the US, but it's still not as liquid as REIT.
A significant benefit to rental property is leverage. If you invest $100,000 into a REIT like Realty Income, you may receive around 5% in dividends every year. However, you could take that $100,000 and buy 5 $100,000 homes, putting $20,000 down on each home. Take a look at this house here, which happens to be selling for exactly $100,000. If your monthly cost was truly $669 per month and you received $675 per month in rent, you would just break even in terms of profits. However, you would be accruing equity in your house, which could be sold in the future. When the house is paid off, the rental payments are pure profit minus repairs, property tax, and maintenance. Let's do the math. $100,000 in realty income with its current 5% yield will give you $5,000 in dividends per year. 5 houses bought for that same $100,000, which make $675 per month in rent, will give you $40,500 per year. See the difference? That's the power of leverage. Leverage also introduces risk, however. If tenants move out, there's a crisis like currently, and renters do not pay their rent, or repairs or other costs are high, you may struggle to pay down the mortgages and may risk losing everything.
If you are the kind of investor who likes to have total control of their money, then a rental property is probably more for you. Considering when you purchase a property, it is yours. You decide what to do with the inside, how much to rent it out for, who to rent it out to, when to sell it. All of that is completely your choice. With a REIT, the only control you really have is when to buy or sell the REIT. You have no say in what properties that particular REIT invests in, or which ones it holds on to, when it sells these properties, all that stuff.
Historically, REITs have returned more than 11% per year. In comparison, private equity real estate investments return just 7% on average for a negative 4% annual underperformance. REITs crush private peers with much lower average leverage, better diversification, a stronger focus on quality properties, and less risky strategies in general. REITs outperform for 3 reasons. First, faster growth. REITs grow cash flow at a much greater rate thanks to better access to low-cost capital, professional management, and scale. Second, REITs win because of a full cycle approach. Private investors take on way too much leverage, leading to exceptional returns in good times and disastrous results in downturns. It's not uncommon for rental investors to use up to 80% leverage, whereas REITs are more conservative and use only 30% on average today. Third, REITs win because of the economies of scale. Size brings costs down. REITs are able to save costs on many fronts.
I'm all for not having to think too much about my passive income, and with REITs, it's similar to investing in other funds. You can just buy and hold and forget about it. Let the money work for you. However, with rental properties, you have to be involved on a regular basis. You're responsible for maintenance, repairs, talking to tenants, everything like that. And sure, you can employ an agency to do these things, but at the end of the day, you have to pay them. So that just reduces your profit margin.
Both REITs and rental properties bring some interesting diversification to your investments. Rental property gives you an investment which is not being traded on the stock market. Its price won't rapidly fluctuate based on a myriad of factors impacting the markets. This gives diversification. However, the rental property is only one piece of real estate. This also presents risk as property values in that area can drop. The benefit of REITs is you take ownership of hundreds or thousands of properties, which may be spread across many states or countries, offering a different form of diversification.
Something I'm very familiar with, down payments on a property. So I got slightly burnt when I was purchasing my property when my mortgage company decided that the 5% I was meant to put down, this is the usual amount that we would put down for a shared ownership property, which is what I have, wasn't enough, and they wanted me to put down 15%. That's 3 times as much. If you aren't using a scheme, a typical down payment will set you back tens of thousands. In the UK, if you assume the average property price of 250,000, which definitely isn't the average property price in London, I'm not bitter at all, but even with the average house price of 250k and the general average down payment that we would pay of 10%, you're still looking at a £25,000 down payment. That's a lot of money for an individual person to put together. Also, if you're from the United States, the down payment you're expected to make to avoid additional fees such as private mortgage insurance is actually 20%, so double what I just said. However, with a REIT, you can benefit from investing into real estate without having to put down any down payments. Coming from the UK, we have slightly different rules around tax than the US. I feel like this all deserves a whole other video, and unfortunately there are so many complications and intricacies within tax that I would strongly advise you to seek professional tax advice. If you're in the UK like me, contact HMRC for any questions around tax you have. However, it is worth noting that in the UK, REIT income is actually treated as property income. So you will declare this on your returns as if you were receiving that income from your own property. So whereas normally you would receive a dividends tax-free allowance where you can receive a certain amount of dividends each year without paying tax on them, REIT dividends do not fall into that category. You pay tax on them as if you were paying tax on rental property income. If you are from the UK and you're interested in any more detail about this, just drop a comment below and I'll make one over on my channel, because I'm aware Ben's channel is focused primarily towards US investors.
Finally, we have interest. You will pay interest on your mortgage when you buy a rental property. Look at this table. If you took out a $100,000 loan and paid $599.55 every month for 30 years, you would ultimately pay $215,838. Not only that, because interest is high at 6%, only $99.55 of your first payment goes to the $100,000 loan. $500 goes straight to interest. After that first payment, you still owed $99,900.45. A benefit to a REIT is that there is no debt and you don't owe any interest.
At this point in my journey, I'm sticking with REITs. They are just far less hassle and I just don't have the time to look after rental properties, but Having said that, I would at some point perhaps like to have a rental property to rent out.
Given the amount of time, effort, and inconvenience required for rental property, as well as the data on total return under performance, I'm only investing in REITs for the time being. Although leverage can provide amazing results, given I already have 2 jobs, I don't have the necessary time to invest in rental properties at this time. Which do you prefer to invest in, REITs or rental property? What do you think are the pros and cons? Leave your thoughts in the comments below.
Please do leave your comments down below. I'm so interested to know what you guys think. Thank you so much for watching and for supporting both our channels. Hopefully see you again in the next video. Bye.
I look forward to hearing from you and learning from you. Don't forget to subscribe to both our channels because we will be creating new videos for you every week. As always, good luck with your investing.